It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. The renewed advance in the U.S. dollar is raising alarm bells with officials in Japan and China threatening FX intervention. A flurry of fresh bond supply. U.S. corporate borrowers flood the market with debt sales while the Fed offloads about $1 trillion of bonds. And the ECB's Klaus exclusively tells Bloomberg that markets may be underestimating the chance of a rate hike at next week's meeting. Welcome to Bloomberg Surveillance. You're watching the early edition. I am Dani Berger in London alongside Sonali Basak in New York. Sonali, it's that bully of a dollar taking a bit of a break. We're getting some more retail sales data also just coming through for the euro area. July retail sales, those fall 1% year over year. The estimate was for 1.2%, better than expected. So maybe the euro can finally fight back against that greenback.
Yes, we'll see about that. And well, let's take a look at the U.S. markets here. Speaking of that dollar, the S&P futures down another day, Dani. We are looking at a little bit of weakness, about 0.2% lower starting the day. Tough week here in the United States. We're looking at the two-year yield also cooling off just a little bit after a sharp leg higher just yesterday. We're looking at it down about 1 basis point, sitting at a 494 handle. The dollar index, to your point, cooling off just a little bit. But remember, it did rise to the highest levels here since March. It has significant ramifications for global currencies. We'll talk about that later in the show, but still just about flat from yesterday's levels. Now, we're also looking at Brent crude. We're going to talk about that OPEC supply extension, the curve here. We're looking at 89 on Brent crude as well. It is down about 0.9% so far, but we'll keep an eye on that as well.
Yeah, when I woke up this morning, that was up and it was at $90 a barrel. So some of that running out of steam. So again, Sonali, here in Europe, we just had that euro area July retail sales data. It was a drop of 1%. The estimate was for 1.2%, so down but better than expected. Retail sales month over month, bang in line with estimates, a drop of 0.2%. Again, estimate 0.2% drop. Now, that's not having too much of an impact on markets as much as I was hyping up the euro finally making a comeback. Euro stocks having a tough day, down about 0.7%, trading more based on bad data, on Germany factory orders, which fell pretty significantly. But the only thing that's really saving us from having a weak euro at the moment and two-year yields not dropping is an interview from our Jana Randau speaking with Klaus. That's, of course, the Dutch ECB member. We'll be speaking with Jana later in the show. But saying that the market maybe is underestimating the probability that we'll get a rate hike in September. Now, he is a more hawkish member. So, yes, we did trade up on the euro and up on two-year yields. But the reason, Sonali, we're not running away with this, again, is because he's a guy who already has that kind of hawkish lean.
Now, when we're talking about the strength of the dollar, raising alarm in Japan and China, remember both are stepping up defense of its exchange rates. We're going to get to this with Eddie Vanderwalt of Bloomberg Markets Live because we are looking at finally some plateauing of the dollar. We are finally looking at other countries looking to respond to the dollar. And so we are looking at a very significant move here in global currency markets. Eddie, this is certainly our top story of the day.
Yeah, absolutely. Look, it does feel like an FX day, and it is because we've seen the dollar rally something like 4.5% from the middle of July, right? And the dollar strength really coming back. That will reverberate across markets. It usually means that people are looking for some sort of haven. I think at the moment, though, what the driving force behind the narrative is that we're starting to see the risk of inflation coming back, you know, with oil prices and so on. And that's feeding through into Asian currencies in particular. And it's forced the Bank of Japan to talk up the risks of, the potential for intervention, and it's forced in China, a lower fixing than people had expected, or a higher fixing from the dollar perspective. And I think all of these things, it just shows that this will reverberate across markets. It's going to matter for EM currencies. It's going to fuel inflation elsewhere.
On China specifically, why, and I realize this is probably just an absolute amateur question, Eddie, but why would the PBOC want to step in? Doesn't a weaker yuan help them because they need more growth right now? Yeah, they do need more growth, but also they like to control their currency. They like to be in control of things. They do not want this to be out of their hands. And I think, just the scale of moves and the pace at which they're happening, I think that is a worry for China. So I think, yes, they would like to see probably inflation coming back a little bit. They would like to see stronger growth. Therefore, a stronger domestic currency or a weaker domestic currency helps them. But
at the same time, I think, I think they would just like to be much more in control of the narrative.
That's our thanks to Eddie Vanderwalt. Now remember, as September kicks off, global debt markets are bursting with new deals, with investment-grade companies rushing to lock in borrowing costs. That's before the central bankers can raise those interest rates further. Bloomberg Markets correspondent Valerie Teitel joins us with the latest. Valerie, what does this
Sonali,
mean?
it was a busy day for those debt syndicate desks yesterday. The busiest day of the year for U.S. investment-grade bond sales, and actually the busiest day we've seen in over 3 years. It just wasn't the U.S., also in Europe and Asia. September is a busy month for these debt deals, and with a lot of risk events on the horizon, with that CPI print next week, and then the Fed the week after, there is a reason for these corporates to rush out of the gates in September and get these debt deals done while markets are still quiet. It did have quite an impact on the Treasury market yesterday, as you commented, Sonali. We did see long end weakness rear its head yet again. This long end steepening that we have seen is continuing because of this deluge of supply. Now, it's very funny because last year and the beginning of this year, the rise in U.S. yields was really spurred by stronger U.S. economic data. And recently, it's all been spurred by supply reasons, by the Treasury increasing its auction sizes, by the Fed's QT still rolling on, and by these corporate bond issuance. So it's really a story about supply heading the bond direction in the wrong direction.
A blessing and a curse here, Valerie, because you kind of just answered the question I wanted to ask, but also speaks to how you're basically a mind reader. But who is buying all these bonds? I mean, as you say, QT is rolling on, and we just passed that threshold of $1 trillion. How significant is it to have all of that sloshing around in this market?
Well, it is significant, Dani, that $1 trillion worth of bonds are now out there available in the market that used to be on the Fed's balance sheet. But the Fed is still sitting on about $8 trillion more. So there's still a long way to go when it comes to the Fed's QT, if it does exactly continue, even though the Fed could cut rates next year. But this is all about the deluge of supply, whether it's coming from the Fed, whether it's coming from the corporate bond market, or whether it's coming from those Treasury auctions being increased in size. And then we also had a comment from the FDIC yesterday. They are going to be auctioning off yet more debt, the failed signature bank loans that totaled around $33 billion. They're also going to be auctioning those to the market. So we're just really getting hit with a lot of debt supply from various parts of the market, which is causing more pain for the Treasury market.
Valerie, thank you so much for that. That is Bloomberg's Valerie Teitel. Now, we're also keeping a close eye on oil this morning. OPEC Plus leaders, Saudi Arabia and Russia, announced that they would extend their supply curbs through the end of the year. Joining us now is Bloomberg's Dan Murtaugh. Dan, you and I spoke, 4 or 5 hours ago? NYMEX crude was at $90 a barrel. It's come down since then. I was really ready to be all bullish oil, saying, where are we going? We're going to $100 next. If we're falling now, have we kind of reached the peak oil price that we'll see in reaction to these cuts?
I think it's too early to say that, Dani. I think the oil market responded yesterday with a big jump in prices because they were expecting the size of these cuts, but they weren't expecting the length of them, for them to last through the end of the year. And what that's doing is it's resetting the market to expect a much bigger deficit. So we're going to draw oil out of stockpiles. That's going to make a tighter balance, and any kind of unforeseen supply disruption that hits the market, that could really cause prices to spike. But at the same time, you have a worsening economic picture. Things here in China have not recovered at the speed that people want to after COVID. The U.S. and Europe are facing possible recessions. And so that demand picture is sort of pulling prices back a little bit. And I think we're going to see that sort of that balance between the supply tightness and whether the economy is going to need enough oil to push prices higher. That's going to be the story we're going to be tracking for the rest of the year with oil prices.
When you're thinking about the supply-demand picture, how are the troubles at refineries contributing to higher prices for drivers?
Yeah, that's a really big and underreported issue. But in Europe this year, we've seen refinery outages almost every week. And in the U.S., the big refining hubs of Texas and Louisiana, they've had a record heat that's kind of slowed operations down. And so you're seeing gasoline prices shooting up. In the U.S. now, We have gasoline prices that's the highest for this time of year in more than a decade. And in Japan, compounding with the refinery issues, the oil price is the weak yen. And so Japanese people are paying record amounts for gasoline. And so that's something governments are going to have to keep track of as they make sure that their people are able to afford these higher energy prices.
Right, and it's not like in the U.S. we could have more SBR releases. That fodder was more or less already used up. Dan, thank you so much for your coverage throughout the day. Bloomberg's Dan Murtaugh in Beijing. Now, coming up, we are just over a week away from an ECB rate decision. We're going to have more from Bloomberg's exclusive interview with Governing Council member Klaus. That's next. Then we're going to be hearing from Union Investment Christian Kopf on why he expects another hike from the ECB next week and get his take on some of these FX moves. Plus, SoftBank's ARM is looking at a downsized IPO of nearly $4.9 billion. All of that still ahead. This is Bloomberg. Welcome back to Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Sonali Basak is in New York. ECB Governing Council member Klaus says investors betting against a rate increase from the European Central Bank may be underestimating the chance of a September hike. Knot spoke exclusively with our Jana Randau, and she joins us now from Amsterdam. Jana, a really great interview. We saw the euro strengthen off the back. We saw yields push higher. I love how he emphasized that it's maybe underestimating the rate hike, and it's a close call. So he seemed hesitant to say one way or the other. Taking Knot's view then in hand, how likely is a hike next week?
Well, reading between the lines and knowing him really well, I would say there's an ever so slightly bigger chance for a rate hike than a pause. But yes, he said it was a close call. The decision is not hasn't been made yet, and will in fact depend on the one thing that we don't know yet, and that is how the inflation outlook develops, how the economy develops. So the economic projections the ECB staff is currently putting together, we haven't seen them yet, neither have the policymakers. What they expect and what Klaus Knot expects is a weakening in the growth outlook and a more or less confirmation of the inflation outlook from 3 months ago. And that is essentially what is crucial, because those forecasts from June showed inflation above the ECB's target all the way through the end of 2025. And he said reaching the target by that time, by the end of 25, is the bare minimum the ECB needs to achieve. Push it out into 26, and that is not satisfactory to him. So that is what's going to sway the debate in one direction or the other. We don't know what the forecasts will show. He doesn't know that yet, hence no clear commitment. But everything else I heard makes me believe that the chances are slightly higher for a hike than a.
The other thing he said about the inflation target, 2% end of 2025 bare minimum, but he also told you he wouldn't mind so much if that target shifted forward a little bit. How popular or unpopular is that view?
Yeah, I mean, I think every policymaker at the ECB, Hawk or Dov, will agree to the fact that inflation has been above target and much too much above target for way too long already. So the sooner inflation comes back to that 2% target, the better. Now, clearly that is complicated. It's not something that happens from one day to the next. Wage deals, for example, play an important role. Those have been really strong. They will continue to be strong, and thus boost demand and keep price pressures high. And we're still seeing that in the economy. The economy itself is slowing, but as Klaus Knot said, it's a feature, not a bug. So that slowdown is welcome, is anticipated. Whether it will be enough to bring down inflation, we'll have to see. And that is the complicated thing. Reading the economy at the moment is really, really difficult. So as you get closer to the end of the cycle, where we are at the moment, it's difficult to say the right or wrong. At the start, it's easy. This time, it's very difficult to figure out how much tightening or what that tightening that's already in the pipeline will have what kind of impact that will have.
Bloomberg's Yana Randa, thank you so very much for that exclusive interview. This year, India surpassed China as the world's most populous nation and now says it's on a mission to build, energize, and connect its vast nation. Ahead of the G20 summit being held in Delhi, Bloomberg takes a look at India's infrastructure landscape.
India's longest sea bridge has been some 20 years in the making. It's expected to open to traffic between Mumbai and Navi Mumbai sometime later this year. The connectivity will redistribute the burden and opportunities of rapid urbanization. Infrastructure building has gathered speed across cities and villages, with the government spending record amounts on transportation, power and housing projects to meet urbanization needs, boost jobs and growth, and to cut logistics costs. India needs trillions of dollars in infrastructure spends, currently supplied by government and multilateral institutions. The opportunity to move, house, power, connect, and transact with 1.4 billion people has drawn corporate investments from local giants Ambani and Dani to international majors Brookfield and Macquarie. But private participation, at less than a third overall, has varied based on sector, policy, and risk. Telecommunications and aviation are mostly private-owned, but with many financial failures. Airports, ports, power, and now new energy are both under public and private ownership. Railways are mostly government-owned, whereas in roads and highways, past bankruptcies have prompted the government to take on construction risk. Lack of long-term financing, difficulties in land acquisition, and even a shortage of civil engineers in a software-obsessed country are all reasons for chronic delays and cost overruns. Half the projects under construction right now are behind time and over cost. Then there are the challenges of quality, safety, and sustainability. India has the world's second largest road network, fifth largest metro network, and third largest construction market. Yet, over 3/4 of the India of 2050 is yet to be built, says McKinsey. That will likely provide opportunities, but many challenges as well.
That was Bloomberg's Menaka Doshi in Mumbai. Now, that G20 summit in New Delhi, it is set to showcase Narendra Modi's attempts to demonstrate that geopolitics goes beyond the U.S. and China. That's today's focus of the Big Take. NI Big Take is where you want to go to read more on that in the terminal. For more now, though, we're joined by our South Asia economy editor, Ruchi Bhatia, in New Delhi. Ruchi, what sort of opportunity is this for India? Is there a concrete takeaway that they are hoping to have in terms of their image after this G20 meeting?
Well, Prime Minister Narendra Modi certainly wants to project India as an economic superpower. And while he's doing that, he has to balance with a lot of confidence and dexterity the other global superpowers, whether it is the US, whether it is Russia and China on one side. In fact, as we can see, Prime Minister Narendra Modi in the last few months has been reaching out to the US President Joe Biden as well. He's going to be here along with many other leaders. We have seen the kind of investment push that is being made by India. In fact, the fact that big companies, big technology companies like Apple and other semiconductor firms are also looking at India in a very positive manner. That's something that goes on to show that, yes, India's moment seems to have come. But on the other side, as countries are looking to move out of China, one has to see how India will look to balance those other geopolitical issues as well. Also, remember, it is going to be very important to see how India will, balance diplomatically getting any kind of a consensus on the final communique as well. So it's going to be a tough task for India going forward,
right.
But definitely something that India wants to show is that its moment has come and it is going to be an economic superpower.
Yep. Certainly got tech companies like Apple backing that narrative. Ruchi, thank you so much for that. Bloomberg's Ruchi Bhatia in New Delhi. And of course, read more of that Big Take, NI Big Take Go, on your terminal, or you can read it on the web. Okay, coming up, UBS is said to be looking at options to reopen Credit Suisse's deal with Apollo. More on that next on Bloomberg.
Now, here's a story we're watching this morning. UBS is said to be reconsidering options to reopen a deal with Credit Suisse that struck a deal with Apollo to sell the securitized products business earlier. That's according to a Bloomberg scoop. The Swiss lender is looking to renegotiate parts of the deal, including fees that were agreed to by Credit Suisse to pay Apollo to manage assets remaining on Credit Suisse's book. Coming up next, we're going to get back to those volatile dollar markets. We're going to speak to Christian Kopf, head of fixed income and FX at Union Investment, next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The renewed advance in the U.S. dollar is raising alarm bells with officials in Japan and China who are threatening FX intervention. And in the U.S., there's a flurry of fresh bond supply. U.S. corporate borrowers are flooding the market with debt sales while the Fed offloads about $1 trillion worth of bonds. And the ECB's Klaus exclusively tells Bloomberg that markets may be underestimating the chances of a rate hike at next week's meeting. I'm Sonali Basak in New York with Dani Berger in London. Dani, what is the European markets telling you today?
Well, I am really focused on that Knot interview that you mentioned, Sonali. We were just speaking with Jana Randau, who exclusively spoke to him for Bloomberg, saying that, Jana is someone who knows Knot well. And from her interpretation, from what he was saying, it's more likely than not that the Fed hikes in September. That is not at all what this market is pricing. We have about 30% odds in money markets that there will be a hike come September. Now, there was a slight adjustment after that interview with Knot, after the headlines broke, but we basically erased all of that. The euro was stronger by about 0.2% at one point. We're now down to basically unchanged versus the dollar. German two-year yields, also their march up higher, was also paired only higher by 1.5 basis points. We're more concentrated perhaps on sour data, Sonali. We got some not great data from German factory orders, and that is feeding into the European session. That's down about 0.5%. How about the U.S., Sonali? How's that session looking?
Absolutely. The international session is certainly floating into the U.S. session because you take a look at S&P futures, they are holding their decline at 0.2%. You're looking at the S&P futures down on the day and second day in a row. You're also looking at the two-year yield hanging at about 4.95. Now we are seeing yields now flat. There was a little bit of cooling. We are watching that reversal happen in front of us. We're also watching a reversal in the dollar once again. This was a dollar that had been plateauing, back on the rise, up less than 0.1%. But of course, this dollar strength is really driving the story across the world. We will keep an eye on it. I know we have a great conversation ahead. Brent crude as well. We are looking at some softening. You were talking about that strength earlier based on the OPEC news. We're looking at it 0.7% lower currently. We're looking at 89.38 on Brent crude. We'll also keep an eye on that through the day, Dani.
Yeah, and Sonali, that higher energy prices is especially a headache if you are a country that's not the U.S. If you're looking at Brent price in dollars, it's all of a sudden getting a lot more expensive for you. That and many other reasons, it raises alarm bells for officials, for example, in Japan, to see a weakening yen. For a radio listening audience, I have just a very simple one-year chart of the dollar yen. We saw it in the most recent sessions go above 148 per dollar. That is above the level, and I should say we're still above the level last year that Japanese officials, that the MOF intervened. We got some strong jawboning from the MOF in the early hours of Europe this morning. We also had Takata, a BOJ official, saying that we should be separating the negative interest rate undoing that debate from YCC. In other words, kind of hinting at that they could make policy changes that aren't necessarily YCC, but would go a long way to strengthen the yen. Let's bring in now Christian Kopf, head of fixed income and currencies at Union Investment, who is in a sunny Frankfurt at the moment. Christian, putting all those things together, has dollar yen basically topped out at this point?
Yeah, my view, Dani, is this is less about the yen and more about the dollar. And if you look at the currency movements over the last couple of months, they've really been driven very much by interest rate differentials. So people were expecting the yen to appreciate as the Bank of Japan is exiting its ultra accommodative monetary policy. But now, all of a sudden, what we're observing is a really remarkable strength of the U.S. economy. We've had the second consecutive rise in the ISM manufacturing index to 47.6. We've had a very strong labor market report on Friday. The little increase in the unemployment rate is very much due to an increase in the labor force participation rate. So all of that is good news for the U.S. economy. And I think this is really driving the yen here, and it's also driving the dollar against other currencies stronger.
Does that mean, Christian, your assumption then, if that's your look on the dollar, that holds through going forward, and it also means that yields in the U.S. Treasuries have yet to peak?
Yes, I think that the idea that we're going to see, rapid rate cuts, which is behind those steep net rates that many people have put on, will be questioned on the back of this very strong economic, performance of the U.S. economy. So, I mean, steep net rates have been super popular. Many people have put that on, 210 steepeners in the U.S. And the problem with those trades is they're negative carry trades, and they are built on the assumption that there will be rapid rate cuts by the Fed. But what we now have to deal with is a situation where a U.S. recession is becoming less and less likely. I mean, for example, Jan Hartzius from Goldman Sachs put out a note yesterday lowering the recession probability in the U.S. to 15%. And that labor market report, I mean, if you had asked me a year ago if we would expect a positive payroll growth to the tune of 87,000 after this big series of rate hikes, I would have said no. No, I would have expected an increase in the unemployment rate, a contraction in employment, and that's not what's happening. So I think that with this level of employment and strength in the economy, we're going to have to rethink rate cuts in the U.S.
Understanding the U.S. strength, but we should also talk here about the reactions that you're seeing from officials in China and Japan. Japan's top foreign exchange officials saying that if these moves continue, the government will deal with them appropriately without ruling any options. But at what point would they have to step in?
Well, I think Japan is in a tough spot, no? I mean, they're in the process of exiting yield curve control at the very time where we see a big slowdown of the Chinese economy, easing of monetary conditions in response to that by the People's Bank of China. And I think that the weakness in the Chinese economy will have a detrimental impact on activity in Japan as well. So they're in a difficult situation. Should they continue to hike in order to stem the, depreciation of the yen? Should they intervene? I think that they will try to tread very carefully here. There will be verbal interventions to start. Maybe they'll do something in the currency. But frankly, you cannot go against the movements of the economy, no? And there is a strength in the U.S. economy. This is why rates are holding up in the U.S. And there is a weakness coming out of Asia. So there's not much they can do about that.
Now, we also have a note from Morgan Stanley this week. They had turned bearish on emerging markets currency from neutral, and the team had written that they expect more weakness, and China macro risks are adding to existing pressure from weak global growth and emerging market central bank easing cycles. They maintain a neutral stance on EM rates and credit. But again, this is a more bearish of a note that they're making, Christian. Where are you most concerned outside of China and Japan for the dollar's strength's impact on other local currencies?
Yeah, that actually is not our view. I mean, we're actually relatively bullish on emerging markets, especially emerging market currencies. You see, emerging market central banks have hiked much faster and more aggressive, actually, than the Fed. If you look at Brazil, for example, or Mexico. And there is weakness now in China. That weakness is partially cyclical, but there is also a structural element of that. Many people talk about deglobalization and reshoring, friendshoring, and so forth. No, that is maybe negative for China's medium-term growth prospects, and that could also lead to a weakness of the Chinese economy. But it's actually positive for a lot of the other emerging markets, just to name Mexico, no, or Brazil. So I actually think that, in the face of very high interest rates and actually improving economic prospects as trade and investment flows are moving away from China into those other emerging markets, we remain positive, especially on the Latin American currencies.
Man, someone needs to get you over to the G20 stat, Christian. I think they all could use to hear from you. Listen, we got to get your views on the ECB. It's right behind you. I think for our viewers, you might have to point it out because it's among the big buildings there somewhere. Just looking at your notes now, you see a hike in September. We are so far from the market pricing that in. I think we only have about 30% odds that they will hike in September. So what do you want to do here? Would you just go long the euro, short Schatz? I mean, that seems like a pretty big dislocation in the market if you do believe they will hike.
Okay, so first of all, we're super laser focused on the ECB. We're in proximity to the ECB. You can see it here right behind me, that tall building, yeah. And we think that with core inflation in the euro area at 5.3%, there is a case for the ECB to undertake one last rate hike on the 14th of September. You see that core inflation is on a sequential basis is really not slowing down. 5.3% is way above the ECB target. And we hear a lot of hawkish comments here. We've got Klaus talking to Bloomberg Television. We've had Joachim Nagel, the Bundesbank president, talking to the German press today, ruling out rate cuts, any early rate cuts. So I think that all of this is pointing to a relatively high probability of one last rate hike into weakness, into economic weakness. That's clear. But, you know, the ECB does have a single mandate, which is price stability. And with inflation rates where they are, I think there's a good chance the ECB will go for one last rate hike on the 14th of September. Now, what does that mean for us? I actually think that this last rate hike is not going to move the needle that much on the rate side. And even on the currency side, you see here the reactions to the Klaus Knot comments on the euro dollar have been quite muted. Yeah. So I don't think there is that much that will change in the shape of the curve. What it does mean is that steep net rates in the euro area are also, you know, far away from making a lot of money. We've got the 210 curve in Germany at minus 40 basis points, very inverted. It's never been that inverted for a long time, but we think this time around it will be different, and the inversion will likely persist because the ECB is unlikely to cut its interest rate anytime soon, and they may go for that one last rate hike on the 14th of September. What it means for us is that there is no case for extending duration here right now, and we stick to relatively short tenors. We like, you know, especially corporate bonds, which offer 4.4, 4.5% yield in 4 to 5 year maturities, and we don't see the case yet to extend duration into this very persistent inflationary environment in the euro area.
Christian Kopf of Union Investment, we thank you very much for your time. Now, coming up, AI stocks are surging ahead of the broader U.S. stock market this year. We're going to get the latest on the AI valuation debate next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London alongside Sonali Basak in New York. So JP Morgan's Marco Klonovich says that investors should fade the artificial intelligence-induced stock market rally. He says while positioning and valuations increase, we think there is now a higher likelihood of a crisis over the next 6 to 12 months. Now, at the same time, bubble hunter Rob Arnaud sees a big market delusion in NVIDIA. He says, quote, overconfident markets paradoxically transform brilliant future business prospects into even more brilliant current stock price levels. NVIDIA is today's exemplar of that genre, a great company priced beyond perfection. Rob always went to wax poetically on the markets. This research note, no exception. All right, let's bring in Alex Webb of Bloomberg Quick Take on this. Alex, if we are judging whether AI is a bubble or not, let's just focus on NVIDIA, because obviously there's a lot of companies out there. How do you separate what is fair future pricing for the potential of NVIDIA versus just way too inflated valuations that get us into bubble territory?
It's interesting looking at Rob's note, because he talks about the price to earnings ratio, but he seems to be focusing on the historical one, which is it's trading at 110 times its earnings that have been reported. If you look at the estimates, it's trading at about, according to Bloomberg, a Bloomberg consensus, about 34 times its forward earnings. That's not actually a massive premium to, say, the NASDAQ, which trades an average of 28 times its forward earnings. In fact, it's pretty similar to Amazon, and it's a massive discount to the likes of Tesla, Warner Brothers Discovery. Now, of course, you could make the argument that those companies are also overvalued. We don't know what NVIDIA's earnings are going to look like in 2 years or 3 years' time. That's really the question. This year, it seems as though it's not a huge number of companies who are really able to compete with it just yet. That may change, and that's when we might start to see some of the heat come out of NVIDIA. But, it isn't easy to catch up. By the time you've caught up with where NVIDIA are today, there's a good chance they'll be further down the line in a year or two's time. It's not my job to say whether this is a bubble or not. I wouldn't trust my view if it were, but there's a lot of nuance in here that is frankly just hard to determine right now.
There's another part of this as well, where you look at the newer companies that are coming to market. You look at ARM and the valuation that it is trying to achieve. And the point that was made in a Bloomberg story yesterday I found interesting. This idea that compared to its U.S. rivals, for example, you have it potentially going public at more than 100 times its trailing 12-month earnings, but that is more expensive than you see some of the others. How do you feel about things outside of NVIDIA?
The thing that's interesting with ARM is that the people running the book are essentially, or the company is asking for a valuation sort of in line with what NVIDIA trades at, right? But NVIDIA has massive exposure to AI and is in the GPU space. ARM is not, right? ARM has a little bit of AI exposure and it rides maybe the coattails of some of the AI stuff, but in the past, in the most recent fiscal year, in the most recent fiscal quarter, its earnings declined. If it had massive AI exposure, it's hard to believe that that would be the case. Now, there may be things coming down the line where ARM will improve its exposure, but it is more in line with a lot of the other chip makers who have also seen declining sales as, for instance, demand for mobile devices has tapered a little bit. When SoftBank took ARM private 6-7 years ago, the big thing that they were talking about at the time was the Internet of Things. The Internet of Things is the future. Everything is going to be connected. That has seen its revenue increase, but it was not at that time talking about AI. It looks as though they're very much trying to frame themselves as being similar to NVIDIA, where the truth is it doesn't really look as though they are one for one in any stretch sense of the imagination.
Oof, so not going to get those NVIDIA-type valuations. A harsh reality, maybe soon to face them in these public markets. Alex, thank you very much. Alex Webb of Bloomberg Quick Take. Now, elsewhere in tech land, Microsoft and Apple face fresh investigations from EU regulators as part of the bloc's landmark Digital Markets Act. That clampdown could end up forcing significant changes in how the firms do business in the region. We learned only just moments ago what companies, what products would fall under this. Let's go to Bloomberg EU competition reporter Sam Stolten, who joins us now. So, Sam, what did we learn? Who falls under the DMA?
Hello, good morning from Brussels here. Well, yes, there are a list of 22 core platform services that will be subjected to these new rules when they kick in March 2024. Among those platforms are the likes of Google Maps, the Apple App Store, also the Windows operating system, obviously owned by Microsoft, etc. But at the same time, the EU has decided to launch a series of investigations to determine whether or not services belonging to Microsoft, including Edge and Bing, and Apple, such as iMessage, should also come under the scope of these rules.
Obviously, those are very widely used applications when you are thinking about these big technology platforms. As the EU investigates those platforms, what type of outcomes do they expect?
Well, ultimately, that remains to be seen. I mean, you would assume that these platforms would reach the quantitative thresholds. A lot of this information is kept confidential, so we don't actually know whether or not they do. The EU has a series of thresholds of which firms will have to meet in order to be designated under the DMA. Now, what the EU actually says is the likes of Bing, Edge, and Microsoft's advertising services do actually meet those quantitative thresholds, but the company has actually put forward a number of arguments to claim that it shouldn't actually be subjected to the Digital Markets Act for a range of different reasons. Now, again, we don't know what those reasons are, but in the past, Microsoft has argued, for example, with Bing, that its market share is so small globally, but also in Europe when compared to Google search, that it just isn't fair for it to be designated and to be hit by these same rules that are really meant for dominant market players.
Our thanks to Bloomberg's Sam Stolten for his coverage today. Now, coming up, a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London alongside Sonali, Basak in New York. Let's get a look at what's ahead today. Get you set up for your trading day. We're going to get some Fed speak. That will include Boston Fed President Susan Collins at 8:30 a.m. Eastern Time. Then BOE Governor Bailey testifies to Parliament at 9:15. We're also going to get some data, services PMI in the U.S., 9:45, followed by ISM services at 10 a.m., plus Riksbank Governor Eric Thiedien speaking at 12 p.m., and finally, Fed Beige Book coming at 2 p.m. First, though, Sonali, some breaking lines coming from the Swiss regulator FINMA. Their CEO, Urban Angahern, will be resigning from the end of September. This is, of course, the watchdog that oversaw the merger, the mega merger of Credit Suisse into UBS. We got to talk about the reason why, Sonali. He's cited high stress levels for stepping down, saying the high and permanent stress levels had health consequences. I have considered my decision carefully and have now decided to step down.
It's an amazing story here because, of course, there was that landmark deal between Credit Suisse and UBS. You have to also remember that in addition to that deal, which was a very highly scrutinized, highly watched, still going through integration, you also have the fact, Dani, that this is one of the strictest bank regulators in the world that is also going through global changes in Basel III endgame standards. And so it is pretty pivotal time here for such a significant bank regulator to be stepping down at a time where that integration is also being watched closely at UBS and Credit Suisse.
In other words, the upsum from what I'm hearing from you, Sonali, is it's not going to get any less stressful for them.
Now, before we head into the U.S. trading day, we're going to take a look at some of the stocks we're watching in pre-market trading in the United States. Let's talk about China banning iPhone use at central government agencies. According to a Wall Street Journal report, Apple shares are only down about 0.6%. Interesting story over at the Journal today. Remember, Apple has a lot of popularity in China. It is its largest international market. So certainly China's move at its highest ranks in government is certainly a significant move, Dani.
Yeah. As you say, its biggest market. It relies on it for about 19% of its overall revenue. And look, is the government just the first step? That's the question that's going to be on everyone's mind. And could it put a chilling effect overall of sales of iPhones in the region?
Certainly, Apple and the United States' relationship with China being watched very closely, especially heading into G20. There are going to be interesting officials there, though apparently not President Xi Jinping himself. Now, Dani, that is it for Early Edition. Surveillance is up ahead. Big day ahead. Still a big conversation around global currencies. I know they will be watching that euro, that yen closely. This is Bloomberg.